Good morning and a warm welcome from a freezing Cape Town to another edition of our IndexMore webinar series, where we, together with our partners at BlackRock, aim to bring you insights from experts on indexation and much more. My name is Nico Katske, Head of Portfolio Solutions at Satrix, and I will be your moderator today. Now, as always, you're welcome to ask your questions by clicking on the Q&A button at the bottom of your screen. Also, just a reminder to stay on for the full duration of the webinar to earn yourself a CPD point. You maybe give 5 seconds more. I see there's quite a few still coming in. So just again, a reminder, you can see the chat button at the bottom of your screen. You can just hit that and ask us a question at any time, and we'll leave some time at the end to answer your questions as well. Now, as we reach the midpoint of another year, it is sobering to take stock of what has transpired in the last year and a half since we've emerged from COVID lockdowns. Now, with Russia declaring unilateral war on Ukraine, global central banks declaring war on inflation, and a seeming war on truth and democracy currently being waged in developed markets that could even threaten our fragile post-war peace, it certainly seems like we are confronted by a wartime sentiment wherever we turn today. Now, in this light, I want to remind you all of what one of the greatest wartime generals, Sir Winston Churchill, had to say in the midst of the Second World War, in what was a truly existential crisis with seemingly no end in sight. A pessimist sees the difficulty in every opportunity. An optimist sees the opportunity in every difficulty. Now, the purpose of this session today is to put on our optimistic lenses and take stock of the very real opportunities available to investors today, specifically as it relates to generationally high nominal yields. Now, the unexpected rise in central bank rates has caused significant strain on the global economy, and notably on developed market banks, many of which were arguably myopic in their belief that capital designated to be held to maturity might not, in fact, see maturity. Now, this rise in global rates also created areas of unique opportunities. If history has taught us anything, it is that uncertainty breeds such opportunity. And today we explore those in the interest-bearing and real asset space. Now, joining us today, I'm very excited to introduce our panel to you to share their expert perspectives. And these are Natasha Blackman. She's the fixed income product strategist for BlackRock's iShares. Good morning, Natasha. We also have Melville Duplessis, who's a portfolio manager at Sanlam Investments. And also then, last but not least, someone that is absolutely no stranger to this webinar series, we have Omar Mufti. He is the lead equity product strategist, sector and thematic ETF design at iShares. That's quite a mouthful. Omar, I hope I got that right. Welcome to you all, and we are super excited to get underway. We have much to discuss, and I'm sure at home you're going to find this enlightening, or at the office, wherever you're dialing in. But before we dive into the opportunities currently on offer, specifically in the interest-bearing space, let's do a quick poll to see whether and how you are currently taking advantage of the high yields on offer. So the question that we ask is, how are you currently accessing fixed income exposure? Are you doing that through active funds, through indexation using, for example, ETFs? Are you buying individual fixed income instruments, or not currently, or I suppose a bit more worrying, not sure? So if you can maybe answer that poll, which will then give us something to speak to when I turn the microphone to Natasha. So I'll give a few more seconds for us. Please select the right answer. Okay, seems like we have our poll ready. So let's view the results. Should come up in a second. Okay, so how are you currently accessing fixed income exposures? So 37% of you said through active funds, 35% of you said through ETFs or some form of indexation, and only a handful of you, 18%, said not currently any fixed income exposure for me, thank you. So it's quite interesting that about 3/4 of you are accessing fixed income exposure through either active funds or through index tracking vehicles. Natasha, I want to welcome you to the proverbial stage. Good morning, and very interesting time. So, Natasha, financial cracks and economic damage from the fastest rate hiking cycle since the 1980s are emerging. Now, with greater volatility and the recent banking tumult on both sides of the Atlantic that I just mentioned, it's become crystal clear how important it is to stay nimble and specifically update investment views in real time. Now, where does BlackRock see central banks going from here?
Absolutely, and good morning, everyone. Q1 of this year was definitely characterized by another period of volatility, and that's really something that investors are just having to get increasingly used to in this environment. When it comes to central bank activity, we're now firmly seeing a new regime play out where central banks are essentially having to face a tough choice about sort of the economy and taming inflation on the other side. At BlackRock, our view continues to be that inflation will be sticky and stay persistently higher for longer, and much higher than sort of that target that central banks have traditionally been looking to meet. And that will ultimately force central banks to keep interest rates higher for longer as well. And we think that policy rate cuts by any sort of DM central banks are unlikely before mid-2024. And that's sort of in contrast to what parts of the market are expecting. Now, given market pricing, that then impacts which markets that we are sort of more comfortable taking duration or interest rate risk in. If we look at the major sort of developed market central banks in turn, for the Fed, we are expecting the Fed to skip June, but we are expecting them to signal optionality for July. Now, that could, change given the CPI data out today. But effectively, we think that they will signal a pause and kind of reflection as more data comes through, but not actually pausing and stopping altogether. And we have started to see some early signs in weakness in jobs, but ultimately we think that inflation remains quite high and sticky, and that will sort of ultimately spur the decision making there. When we turn to Europe and look at the ECB, we think the ECB will likely hike by another 25 basis points this week, which is sort of priced in already, and then keep kind of further optionality for July from here. We see them hiking at least one more time. Macro weakness is starting to come through there, and although core inflation is still high, it could actually come down faster than in the US market. So we sort of see the interest rates really kind of working their magic on inflation over there. For the Bank of Japan, we think that they will likely start to signal a pullback from the kind of ultra loose monetary policy that we've been seeing through tweaks to their yield curve control. Now, the timing for such a tweak is not clear to us, but it is something that is widely expected now by the market as well. So we don't think the market reaction necessarily will be particularly strong there, but certainly something to look out for. And then finally, turning to the UK, despite inflation clearly remaining pretty high and stickier than Europe and in the US, the market's pricing of the rate path is pretty hawkish in our view, actually. It is pricing a peak of sort of 5.5%, which we think is too high. So we see the sort of peak interest rate there going to 5%. So overall, in terms of the picture that we're seeing, central banks are facing a pretty tough choice. We think interest rates will be having to stay higher for longer to tame inflation, and ultimately that will, obviously have, economic impacts in the markets as well.
So related to what you're saying now, what are some of the tactical and strategic investment themes that you at BlackRock see in fixed income as an asset class more broadly right now?
Absolutely. So when it comes to investing themes, I think the first is really related to what you mentioned earlier, the need to stay nimble and flexible in portfolios. So as market and macro volatility is rising and has been pretty high since last year, really, and continues to be so, we think it's incredibly important for investors to regularly reevaluate their views and reevaluate their portfolios and, think about how they can inject that flexibility into their portfolios. And this is sort of one of the reasons that we see ETFs being used more and more by a number of different types of investors, really to regain and to retain that kind of flexibility and liquidity in portfolios. More broadly, an overarching theme this year for investors who are looking across asset classes is really the opportunity in fixed income. So fixed income, as key topic for today, it's clearly, kind of reset in terms of the yield environment, and we're seeing, fixed income actually as an asset class deliver income, which is something that hasn't been the case for a very long time. So a lot of investors who previously were not investing in the asset class because yields were not particularly attractive, or the asset class was not necessarily offering appropriate diversification for equities, now they're sort of looking at it again from a more strategic perspective. So we are speaking to a number of clients sort of around that theme. If we look within fixed income asset classes, I think it's, a pretty well advertised view from BlackRock has been, kind of our focus on higher quality assets. You simply don't need to take a lot of risk to get decent income within the fixed income asset class more generally. So that has focused our efforts kind of and our focus around the government bond sector, especially in the short end. In the US, we are, more comfortable looking into the belly of the curve. So that means a kind of 3 to 7 year part, as we see that as quite a stable place to be, given that the front end could be volatile, linked to the Fed sort of stopping and starting on sort of the remaining interest rate hikes from here. And the long end could be impacted by investors who may demand what we call a higher term premium, which is really higher compensation for holding longer dated bonds. There is the additional potential impact of kind of the BOJ policy that I mentioned earlier, which could lead Japanese investors to expatriate funds from US treasuries into JGBs, which could ultimately put a little bit of pressure on long dated treasuries as well. In Europe, as we see kind of the cycle a bit further in terms of kind of taming that inflation, we are a little bit more comfortable taking duration risk within European government bonds. And then also in the UK, where I mentioned that we feel the market is actually a little bit too hawkish, we're also more comfortable kind of incrementally on the UK gilt market. When we look further down the risk spectrum within sort of corporate bond sectors, again, we have been quite focused on high quality, so investment grade credits in terms of exposures, especially in the shorter part of the curve to start the year. We have seen less interest from investors, both at BlackRock, but also externally in terms of the higher yielding sectors, particularly given the economic uncertainty on the horizon and kind of the implications that tighter financial conditions could have for high yield or sort of junk rated companies. But to barbell the sort of higher quality conviction, we have a much more favorable view on EM local currency debt, where we think that central banks are further along the rate hiking cycle than DM central banks, and the EM local currency asset class could also benefit from kind of a weaker dollar. Inflation linkers, finally, as kind of a topic, given inflation and our expectation of it remaining higher for longer and than the market has been expecting, we have liked inflation-linked bonds for quite some time. It's not an area that actually investors have been allocating to in big droves within the ETF space, and we can come on to that later. But it certainly is an area that where we have seen quite some value.
Fascinating. Thanks for your insights, Natasha. I'm going to come back to you in a few minutes. I just want to welcome our next panelist, so Melville Duplessis, who is Fixed Income Portfolio Manager at Sanlam Investments. I want to welcome you to the proverbial stage. If you can maybe turn on the camera, give us your winner smile. Really interesting discussion there or perspectives there from Natasha. I see quite a few questions coming in the Q&A specifically around inflation globally and locally as well. So I'm gonna keep those on ice for our discussion at the end of the session. For now, Melville, I want to turn to you and let's maybe take a step back and comment on. So I want you to give us the local and the more the EM flavors. And Natasha's done a great job for laying the land, so to speak, from a global perspective. But much has been made around EM equities being notoriously volatile and deeply cyclical over time. Now, consider that EM equity index, the EM equity index has seen peak to trough variation of more than 20% in 19 of the last 20 years. That's incredible. And individual stock performance dispersion has been even greater, with close to 2/3 of the stocks in that index seeing average variation of more than 40% peak to trough. But we all know that with volatility comes opportunity. And so my question to you, Melville, is do we see similar opportunities in the EM fixed income space like we do in the EM equity space? Can you maybe sketch us a lay of the land, so to speak, for EM fixed equity and what investors need to consider before they explore investing in EM fixed income more broadly?
Thanks so much, Nico. That sounds like such a simple question to answer, but yeah, we could spend a lot of time trying to unpack the various aspects of that because, I think as everyone knows, fixed income can get quite complex quite quickly. Natasha spoke very well to the international and the dollar universe and the global context. And already, we're at a level of discussion where once you factor in inflation dynamics, central bank policy dynamics between countries, only in the developed markets, you face quite a multitude of decisions even before you go down, the credit quality spectrum and so on. So taking the leap into the emerging market universe and, contrasting that to the developed market universe, I think some notable points I'd just like to make on the onset is firstly, the considerations are important, firstly, from a local currency debt perspective versus a foreign currency or a so-called hard currency debt perspective. That's a very big contrast or important consideration when you are going into specifically emerging market debt. The return drivers of those are definitely different, and your return outcomes can be vastly different, in particular when a sovereign or the counterparty or the country you're investing into faces some kind of internal macroeconomic challenges or difficulties. I think most investors are already quite aware of that, but the complexities around that, also when you then further introduce just the term structure considerations in terms of where on the curve you want to be when you are investing in, say, the country or the region that you've specified as an investor, then you have to take into consideration the amount of interest rate risks or, where on the term structure of interest rates you want to take exposure to those counterparties. So, already I think I'm using terminology that sounds like all sorts of acronyms that aren't well placed here, but that those are the type of considerations that are very important when you do construct fixed interest portfolios. And I think just the second point that I want to bring into the conversation before taking up too much airtime, I do want to come to some sort of a conclusion that may be useful, is to say that the other consideration is that when it comes to fixed income, the big irony is that the more indebted nations have obviously more debt outstanding. And Nico, you'll be well aware of that becomes quite a challenge when you're constructing passive indices or any kind of an index of fixed interest, or the fixed interest universe is per definition the more indebted counterparty, whether that's a company, a sovereign, or whatever, has a higher weighting in that index, which is exactly the opposite of what you want. That's the big irony when it comes to fixed interest investing, is the more indebted counterparties have more, make up more of the investable universe. So I think that's maybe also why in the poll you ran at the onset, I think that's maybe one of the factors why most investors do use some form of active management rather than passive management when it comes to accessing fixed interest universes. I suppose, I'm not an expert in terms of what the general investor base looks like or so on. I think, and that brings me to the conclusion, is I think if you're the type of investor that has identified a specific region that you want exposure to, whether that's, call it US Treasuries, that's fantastic. Buy an ETF on US Treasuries because you've identified that as the region or the exposure that you want. Similar to South Africa, if you've made a decision that you want exposure to South African rand denominated debt, there are a whole host of products or indices that are suited for that. But going through the international investable universe of regions, markets, instruments, and constructing a well-balanced and diversified portfolio of international fixed interest securities is, well, a full-time job and quite a complex one. And I think, that's also where I think it is a big benefit being part of a larger institutional investment base when it comes to fixed interest investing, to have that kind of an access to global research and access and coverage of all the appropriate markets to make a more informed investment decision at the end of the day. So I think that's quite a mouthful. I don't think I've entirely answered your question because it is a fantastically difficult question to answer. But I think those are some of the most important factors to consider when you look at fixed interest markets or global and local fixed income investing. I think it's important to consider, what type of risk you're taking. I didn't even speak to the inflation risks or the credit risks really. But I think those are some of the most important considerations: is where do you want to be? What type of exposure do you want? Local or foreign currency? Do you want active or passive approaches? And if you take a passive approach, just be aware of some of the potential minefields that are out there when you access via those vehicles.
Now, if you think that was a fantastical, difficult question, hold on to your seat there, Melville. It is definitely the case, that fixed income is incredibly complex. I've heard someone say once facetiously that, fixed income investing is simple. You just have one variable to consider, and that's market interest rate. But that variable is incredibly complex, right? And there's much more to it than simply looking at interest rates. I want to turn to an even more difficult question for you, Melville, and that is the past year we've seen significant pain for our local currency, the rand, losing more than 20% in value to the dollar from just a year ago. Now, much has been made of the currency's demise and its peer-leading volatility and all of the rest. But before we discuss the local fixed income landscape specifically, what's your view on the currency? And should we be stocking up on our rand hedges a bit more?
Wow, Nick, you're following that up with a view on the local currency. I thought we were getting along so well, and now you're posing me all these difficult questions. So, so jokes aside, the currency is exceptionally volatile. The rand is well known to be pretty much the most volatile currency on the planet due to a number of factors. It's an EM currency. It's highly liquid, so it's just it's a very efficient instrument to utilize to express a view on EM, given the correlation considerations and, as mentioned, the liquidity. However, so far this year and more recently, we've really seen the local or the idiosyncratic risks play a much more important role when it comes to the currency dynamics. We saw it weaken to above 19 to the dollar during May, pretty much the weakest level on record. Of course, this massive rally more recently on the back of more positive local developments. And that's what's really weighed on the currency. So we do take a longer term or a medium to longer term view on currency or the currency's valuation or where it should trade relative to peers. For example, purchasing power parity or PPP, which is a very useful metric in the long term to determine where exchange rate levels should be relative to one another. And certainly, we do still take that as an important consideration when looking at the local currency. Having said that, we do think that the currency is beyond the weakest level that it should be. We don't expect it to strengthen materially to what the long-term fair value should be in the near term. But we do believe it's exceptionally weak. And we do factor that in when it comes to constructing portfolios. I think locally, we've seen it time and time again, the early 2000s, 07, 08. We've seen locals or, the local investor base quite keen to take capital offshore when the currency is at its weakest level in the midst of some crisis. And then we see the currency strengthen materially from that point onwards. And we think it is a similar juncture at this point. It's an exceptionally huge amount of negative news or a cloud of negativity hanging over the country at this point. I don't think, to my memory anyway, I've seen the local environment and the sentiment be as negative as it is at this point. And hopefully the one of the silver linings out of that is to say that when we've been at these type of junctures before, we've seen asset prices trade at depressed levels. It's hard to see the wood from the trees, and we have seen exceptional gains or good performance then come to fruition in the years ahead. So potentially that is a similar kind of a scenario where we are at now. We do see some very constructive plans on the table to help alleviate some of the issues that are weighing down the local economy and weighing down valuations on local financial markets. But just coming back to the currency specifically, the currency is exceptionally weak. We wouldn't advise clients to take capital offshore at these type of levels, or if you do, do it on a hedged basis. So take advantage of offshore valuations or diversification and so on, and hedge some of the currency exposure back. But having said that, it is exceptionally volatile. And to your opening line, volatility should be our friend. Volatility is never pleasant, but if there was zero volatility, then all asset prices would just move up in a straight line over time, and we wouldn't have as much to do on a daily basis. So volatility does create opportunity. It's there in financial markets for us to utilize as a tool to add alpha or performance or value to portfolios over time.
Amazing. And I can't agree with you anymore that the current volatility and uncertainty and all the pessimism, as I alluded to earlier, it does certainly create opportunity. And, much has been made of the very high real yields that are on offer in our local bond market. With even cash currently offering great real yields with near zero credit and duration risk. Now, with a liquid market, attractive yields, and a local central bank that is determined to contain inflation and maintain currency stability in South Africa, why are yields still so elevated? Do you have some insights into why yields are still so high?
100%. So, just to, lay it out, our policy rate, the repo rate's at the highest level since, pretty much 2006-07. Essentially, it's the highest level in 20 years since the turn of the century, so far in the 2000s. Similarly, our government bond yields, 10-year, 0.20 or 0.30 point, is also trading at the most elevated level so far this century, which, just to jump to a conclusion, is great from a portfolio construction perspective. If I'm looking at yields, just ignoring the dynamics or the risks in the background, but yields up front when I'm building portfolios are in the entire fixed interest investable universe in South Africa at their highest level, that we've seen them for, the most of our portfolios looking back the last 10, 15 years. So a lot of things can happen going forward, but that's a good starting point. Okay, so why are they at these levels, or the risks, as you point out? So there's a number of factors. Of course, we've seen inflation tick higher in South Africa. So that's, of course, why our policy rate has moved up. But in addition, the central bank has responded to the currency weakness more recently. And that's why we've seen the policy rate move beyond where most people were expecting it to go so far this year. When it comes to our bond yields, a number of other factors also weigh on the yield curve. Of course, monetary policy pricing to the shorter end of the curve, but the longer end of the curve pricing in inflation risk as well as fiscal policy considerations. So, that's true as more generally speaking, but at this juncture, very much we're seeing, that come through strongly in terms of the long end of the yield curve, still trading at very steep levels, normalized a bit the last 12, 18 months or so with the policy normalization that we've seen, but still, even though the curve's a bit flat, it's still trading at a very steep level, which again gives us the opportunity to take advantage of longer yields while we're seeing the US curve invert. We still have an ability to take advantage of yields at higher level the further out in the curve you go. And typically, around the 10 to 12 year area of the curve or the belly of the curve, that's where the marginal utility per unit of risk or your yield per unit of duration starts tapering off. You don't have to go too far out in terms of the term structure or introducing duration into the portfolio to really see the value come through into the portfolios. And I think another dynamic that's really filtered into our local bond yields trading at elevated levels, which isn't, true throughout the cycle, which is a bit of a unique point where we're at the moment, is we've really seen the foreign investor base dissipate from our local bond market. So it was well known that going into 2017-18, foreign investors formed a big part of the investor base in our local currency debt. It peaked at about 41%. Just over 40% of our local government bonds, so local currency debt issued by the government, was owned by foreigners. And that was, of course, a number of factors, but we saw global interest rates go to zero and even negative levels. And there was this massive hunt for yield. And as part of that, investors really flocked to South Africa. That was prior to a lot of the SA-specific risks came to the fore. And subsequently, we've not only seen international yields drift higher, so the global investable universe become more attractive, but also South Africa's specific risks started to weigh down. And we've seen a massive increase in issuance of local government debt. So if you go back to 2018, where the total amount of debt issued by local government was around 2.5 trillion rands, that has now increased to 4.5 trillion rands as we stand here today. So almost doubled. But on top of that, the foreign investor percentage holdings has declined from just over 40% to now, just under or just over 20%. So roughly halved. And that's a massive amount of additional debt stock to take up. Long story short, or that was the long story, to answer your question, I think that's also what's enabled our yield curve to just drift higher, is this, you can call it an anchor tenant, so to speak. This foreign investor base that was, for the most part, very stable and quite large, has now not completely disappeared, but is a much lower proportion. Definitionally speaking, if the foreigners aren't buying a local debt, the locals have, and the capacity for the local investor base to take up that amount of debt stock is just quite limited. So we can quite well quantify and understand the reasons for our yield curve trading steep. And we're well aware of a lot of the risks, the fiscal backdrop, the macroeconomic backdrop, of course, energy supply and Eskom also weighing over us. But once you've factored that in, and just circling back again to the portfolio context, you can build a you can build a portfolio with a potential return outlook or a yield, so to speak, at a much lower level of risk, but still with a almost more appealing potential return outcome at this juncture, or certainly for, compared to the last 10 or 15 years. We are very, I don't want to use the word excited, but we're very constructive in terms of the potential return outcomes you can see out of local fixed interest portfolios, just given where we are from a overall yield compared to macro or risk perspective.
That's a fascinating point, and I think it's an underappreciated point. Thanks for sharing that, Melville, in that foreign holdings of rand-denominated local debt has halved over the past decade, I suppose. And if that absorption, if you like, of local debt, if that halves, well, it has to come from somewhere, that demand. And if demand starts going down, of course, that's gonna hike up yields. So it's a fascinating perspective, and I think something worth considering. And considering all of what you're saying, I want to end off with our discussion with you, and thanks for your time, is just where do we see the best opportunities currently from your perspective for investors to take advantage of the real yields on offer? And are you seeing flows into these pockets of opportunity, specifically comparing the long end, short end, ILBs as an example? Where do you see the biggest opportunities, and are investors taking stock of this?
Thanks, Nick. So I suppose the short answer is everywhere. Perhaps you're asking, if you're asking someone with a hammer, where does he see the opportunity? Then, he's going to answer nails. But from a fixed interest portfolio perspective, I alluded to this before, but we're seeing, what is the investable universe in South Africa entail? It's floating rate assets, fixed rate assets or nominal bonds, and then inflation-linked bonds. And all of the above are trading at the highest yields that they have so far this century, call it 20 years essentially. So, that's a great starting point. It's way better than being on the opposite end where, yields are zero and you have to still consider the same or similar risks. So we're seeing a lot of opportunity there. Where we're not seeing opportunity is in the credit markets, which is a bit disappointing. We're hoping there's a bit more traction, but, local corporates or credit issuers are sitting on very healthy balance sheets. They don't really need the capital. So we're not seeing them issue a lot of debt. So, that part of the investable universe, we'd love to see that tick up a bit. It also, potentially be a reflection of a lot of reinvestment going into the SA economy. I think for the longest time during COVID 2020, 21, 22, we saw local floating rate assets and credits per se, because a lot of the issuance is tied to floating rate, just traded all in yields that were, very low, 5.5%, call it. Now with the policy rate, almost doubling, you're seeing that whole floating rate component or, credit potentially trading a lot more attractive levels from an all-in yield perspective, but the credit spreads still remain depressed. Having said that, when you're building a portfolio, you can still build a very high quality portfolio from a local perspective with a very decent all-in yield. And again, the entire investable universe is trading at, essentially the highest level in a long time. That looks fantastic. And when I said everywhere, I almost did mean that in the largest extent. We're similarly looking at offshore markets. Similarly, the Fed funds rate is trading at the highest level that it has for essentially the last 20 years since the .com bubble burst, except for, call it just over a 1 year period from 2006 to 2007. A big contrast to, what we saw for the biggest part since the global financial crisis, where we saw zero rates and negative yielding debt to the amount of $18 trillion outstanding internationally, which is now, of course, completely unwound. So all of a sudden, you're looking at a global and a local fixed interest investable universe that's giving you a lot better yield or valuations up front, which, I think is genuinely exciting from a portfolio construction point of view. And I think that's also, where we're trying to just distinguish, what the current return outlook going forward is from, what we've just experienced. I think we're all still pretty scarred from 2022. We all should have expected rates to increase from zero. It was, to an extent inevitable. But when it did happen, the repercussions from a financial market return perspective were very significant. So I think we shouldn't extrapolate, the more recent or past experience in terms of financial market drawdowns too far into the future. And I think, we are at a great juncture at the moment to build, quite decent portfolios with good return outcomes. And maybe to Natasha's point, without going too far down the quality spectrum, you can build high quality, good return outcome portfolios, hopefully, for yourselves and investors at this point.
Amazing insights. Thank you so much, Melville. And on that point of reference to Natasha, I'm going to ask you to join us again, Natasha. But before we do that, I'm going to give you all a break for a second. I want to bring up a second poll. And in this second poll, I want to ask you, are you increasing your fixed income allocation in the current environment? Maybe you might be biased slightly about by what Natasha and Melville said just now. So if you can just answer that quickly, if I can just give you a second. So on your screen, it'll come up, are you increasing your fixed income allocation in the current environment? Yes, no, I've already increased it, or I don't know. And maybe in that I don't know segment, we can maybe give you some more clarity after this discussion. I see the questions are coming in thick and fast, so keep them coming in. You'll see your Q&A button at the bottom. So if you have anything on your mind, please add it there. We'll collate the questions and we'll have a nice, robust discussion with our panelists at the end. So let's end that poll right there. So I see that we have, so 36% of you are saying yes, you've increased your fixed income allocation in the current environment. Equal 36% of you are saying no. 15% are saying, oh, wait, I've already done that. And then about a 13% number of you are saying, well, I just don't know. So maybe if we can turn those 13% into a yes or a no, Natasha, if we can maybe come back to you. So 30% are saying yes. So 1/3 of our respondents are saying yes, they've absolutely increased, and another 15%, so call it half of our of those dialed in, are saying yes, they've increased their holdings. Now, are you currently seeing significant flows into bond ETFs from your perspective, Natasha? And do you have any insights into how clients are currently incorporating these building blocks into their portfolios, considering how the asset class has turned, to Melville's point, from near zero yield on DM debt instruments to comparatively attractive yields currently? How are you seeing that play out? Are investors taking up this opportunity?
Absolutely. So it's great to see the poll results, because they actually do mirror a lot of the comments that I was about to make. So it seems to be some consistency there. Globally, we've seen, if we look across the ETF landscape, we've seen 150 billion of inflows into fixed income ETFs. And the majority of that is in the US market. But it tells a pretty interesting picture from a global perspective, because you have some similar trends across Europe and in the US, which are the major components of that, but also some divergences. So the 150 billion is pretty strong. It's ahead of the run rate that we've seen in previous years. So definitely an indication that investors are using kind of ETFs to allocate to fixed income, potentially to take advantage of that kind of those higher yields, but also to sort of be more tactical in the higher sort of volatile environment that we talked about earlier as well. So when we look at the breakdown, it's quite interesting to see that the vast majority of flows, so 110 billion of the 150, are made up of government bonds, especially US Treasuries, as well as multi-sector funds. So multi-sector funds are those that combine different fixed income asset classes, usually kind of global aggregate or US aggregate, Euro aggregate indices. So quite sort of overall, your sort of core building block type of exposures. And if we look at kind of over the year, since January, how flows have evolved, I'd say January was really kind of characterized by more of a continuation of a risk-on theme that sort of developed in Q4 of 22, where people turned a little bit more positive on risk assets, and credit funds, especially so corporate bond sectors, attracted quite a lot of the flows in January. And then turning into kind of the rest of the year, and as the sort of volatility unfolded, especially with the banking turmoil, we saw, more of a kind of flight to safety allocation. So it really moved from kind of risk on to more sort of safe haven type of flows. So that's where you see the government bond flows really coming in, and US Treasuries being a big part of that. In the sort of higher risk segments, we've seen, a kind of a completely different picture, I would say. So in high yield overall, we've seen outflows from the ETF landscape, especially in the US. So in Europe, we've actually seen investors more positive towards higher yielding sectors, but in the US, those flows have outweighed the European ones. And from a global perspective, it's been outflows and so negative flows. From kind of the emerging market debt perspective, in aggregate as well, we've seen small outflows across the industry in fixed income ETFs. Again, speaking to kind of investor caution, but I would say month to month, it's been, kind of quite differentiated. So in some areas, we have started to see some interest emerging, especially in the local currency sector, for example, within the European market. So far in June, when we look at flows kind of up to kind of the first couple of weeks, we are starting to see tentative signs of a bit more risk taking in high yield as well. So we'll see how the rest of the month pans out. But government bonds continue to be kind of a core area that investors are allocating to. And kind of to your point around how are investors using these in portfolios, I'd say it's a bit of a mix. In Europe, we haven't really seen investors move their portfolios in a broader strategic sense towards, really upping fixed income in a significant way. Of course, we have been seeing investors start to incorporate fixed income more into their portfolios, and we're having a lot of client conversations around how to do that effectively, depending on the investor's risk and return objectives. But ultimately, we think there's more to come here. And when we look at average kind of multi-asset portfolios, we see a general underallocation to fixed income relative to what BlackRock would be sort of modeling in their portfolios. So we hope and expect to see much more allocation towards fixed income as the year progresses. And I think that ties well back to the poll results today, where you see that, some investors definitely are actively doing it now. Some have already done it. And that's, from our perspective, great. But at the same time, there is still a significant portion out there who are yet to move, and that we hope and would expect to start to reassess their fixed income allocations.
Amazing. Thank you, Natasha. I'm going to invite our last panelist, Omar Mufti, product specialist within the iShares EMEA strategy team, to give us a bit of a different perspective. Now, I've taken in confidence, Omar, that you are the exact person to answer this question that we got in the Q&A. What is fixed income? I heard you are specifically well placed to answer that question.
Yeah, I was telling Nico that my first job interview was for a fixed income specialist analyst, and I went into that interview thinking that fixed income referred to the salary that I would be paid, and was extremely excited coming out of college for a fixed income role. But no, unfortunately, I'm more on the equity side now. So hopefully there's some interesting questions on equities that I can help with.
That's the last question I'm going to ask you on fixed income, and I want to pivot the discussion a bit to go into the equities, maybe just to answer. So fixed income, that's interest bearing assets like bonds or money market instruments where the income is fixed and you can project that. Omar, considering what is on offer in the fixed income space and what we've been discussing up to now, and just how attractive these nominal yields are compared to a few quarters ago, it's worth discussing also some of the higher yield proxies on offer in the listed equities space. Immediately comes to mind real assets, such as property and infrastructure companies, and they all have their own unique high yield opportunities as well. Now, first, how has infrastructure companies been affected by the rising rates, and what is your view for the near term on this real asset class?
Sure. I guess the summary of it in terms of our view is that the near-term backdrop for infrastructure is looking incrementally more attractive than it has so far year to date. And there's been a lot of talk about inflation, about rates, and that is really the common link from infrastructure to the fixed income side. And broadly speaking, infrastructure, if we look back at the recent past, held up extremely well as the world moved quite suddenly in 2022 from a low inflation regime to a high inflation regime. Now, how do we assess how listed infrastructure did? Now, we look at the FTSE Global Core Infrastructure Index, and that offers really the most comprehensive approach to infrastructure. It invests in listed companies across, transportation, whether that's railways, ports, airports, roads. There are utilities as well, so energy generation, distribution, water, and of course, telecoms. And this index succeeded in delivering returns of -6% in 2022, And that may not sound fantastic, but we have to remember that the context was a global equity market that was down some 19%. Now, all of that is in US dollar terms, of course. So that said, strong outperformance on the whole for infrastructure, meaning it held up its part of the bargain as being a relatively defensive, lower volatility equity segment. And it's interesting to note that actually infrastructure performed best as inflation was rising quite markedly and dragging down much of the rest of the equity market. So showing that quite unique aspect of the asset class, which is that strong inflation pass-through. Companies in the listed infra space were able to pass on rising price levels either because they have explicit contracts and concessions that allow that, such as with a toll road, or it's implicit because they have these monopolistic assets. You know, many infrastructure assets are unique to their geography, for example, a port. So that was 2022 when we saw that real spike in inflation. 2023 has been much less powerful, unfortunately. Infrastructure has effectively been flat, while the broad equity market has rallied quite dramatically in a sense. But it's important to note that the equity market rally this year has been special in as much as it hasn't been very broad-based. It's been quite narrow, driven by a handful of big tech stocks. So what do we expect from here? Let's look at the near-term outlook. Our view on global equity markets as a whole is that we are urging a modicum of caution. Now, caution is not the same as being negative, but we think that caution is warranted. If you look at recent data out of Europe, shows that the Eurozone has slipped into recession, and we also believe that that is or will be the case in the US as well. And this recession is almost foretold. I think Natasha was alluding to that. Demand destruction has been one of the goals of policymakers to temper high inflation. And that has typically been a difficult environment for equities recession. So in this recession scenario, we favor quality exposures, and infrastructure has those quality attributes, whether that's through its resilient, defensive, monopolistic assets and that long-term cash flow visibility. So all in all, our sense is that there's a constructive near-term backdrop for infrastructure.
So that's the near-term perspective. And I like what you say about defensives. And, defensives are definitely something that we've also seen clients are looking to add to their equity portfolios for the shorter term. But if we zoom out a bit to the longer term, let's say, there seems to be increased policy support for infrastructure development in the current political landscape. Following decades of underinvestment in this area in developed markets, particularly, as well as growing populations and a growing need for infrastructure investing. It does seem like there's longer term opportunities in infrastructure more than just the short term defensive nature of it. There's actually a massive opportunity there. Would you agree with that?
Oh, no, absolutely. And I don't want to represent infrastructure as just a defensive play. That, in our view, is really just the narrative for the nearer term. And in fact, the nearer term is more uncertain. The longer term is actually is more certain. As we zoom out, the future becomes quite obvious. And in fact, from that prism, the offensive side of the infrastructure equation, the long-term growth aspect, is actually very interesting, as you alluded to. And we actually think of the structural growth angle for infrastructure as the 4 Ds. That is demographics, decarbonization, digitalization or digitization, and deglobalization. So the first, demographics, that's always been a key driver of growth for infrastructure. Today, it's maybe shifted slightly towards one that is especially true in emerging markets and less so than in DM. But the other 3 Ds represent really some of the key forces that are shaping our era, and not just in investments, our era, of humanity, society, the economy. So we can start with maybe the most existential of those threats, and that's possibly makes it one of the biggest opportunities out there, and that is decarbonization. The transition in the power generation space from what is today 2/3 fossil fuels to reversing that equation to 2/3 renewables, that represents a $9 trillion opportunity by 2050 for infrastructure markets. That shift towards renewable is an opportunity for the utility space, for new projects in their traditional sphere of operation. So, solar, wind generation, expanding the grid, expanding transmission lines and distribution. But it also opens up a whole new segment, a whole new bunch of segments, whether that's grid level storage needed to accommodate greater fluctuation in renewable energy production. That's EV charging. There's a whole nascent economy around hydrogen that needs to develop. So this is going to drive the sector's structural growth over the long term. And here, benefits are coming from policy support, in droves. Really, you have the Inflation Reduction Act in the US, the EU Green Recovery Program. All of these are really helping the infrastructure space move towards access that decarbonization opportunity. The second of those, new Ds is deglobalization. After COVID and the return of geopolitical tension that you mentioned, Nico, in your intro, companies are maybe not as focused as they had been on pure cost efficiency, outsourcing to the cheapest, but increasingly on resiliency. That means, more diversified, more regional production, new networks being created, and there's an opportunity to develop new infrastructure to really support these new supply chains from ports to rails, for instance. And at the same time, and maybe coming to, I guess, the last of the 4D is companies are increasing technology adoption to manage, and improve the flexibility to mitigate future disruptions. So that last D is digitalization. And that is really transforming our daily lives and requires, physical and systems infrastructures that are quite onerous, whether to accommodate the online work, e-commerce, next day delivery, schooling, entertainment, all of these are very demanding in terms of data infrastructure. And recently this year, we've seen the rapid acceleration and adoption of AI. So for all this, you need infrastructure, whether that's 5G mobile technology, whether that is for the Internet of Things, or even for self-driving cars that rely on that, or whether it's also data centers. All of this is gonna be supported by the development of new infrastructure, and that is going to support continued growth in this space. So basically, those 4Ds of demographics, decarbonization, digitalization, and deglobalization augur an attractive opportunity set for long-term growth for the infrastructure space.
Amazing. Thanks for your insights, Omar. And I want to just maybe turn to some of the questions that we are getting from those dialed in. I see there are quite a lot of questions. So Melville, if Natasha, Omar, if all of you can stand ready for me to shoot from that. But before I maybe just get to that, just to echo your sentiments there, Omar, we've done our own research. So we have a feeder ETF, locally rand denominated feeder ETF on the JSE that feeds into your infrastructure fund. And what we've found is that it provides the diversification from a growth perspective. So your MSCI World Index, for example, has a very strong growth flavor to it. Like you mentioned, there's a handful of stocks that's driven up, buoyed up equity markets globally. But what infrastructure adds is, even though it's listed equity and it is a comparable return profile, it certainly does add that counterbalance to the growth that you're getting in other global other global equity indices. And we're quite bullish on the importance of adding that diversification and also getting that higher yield, because those infrastructure assets that you mentioned are quite attractive yield propositions as well for investors to consider. So maybe do your work on that. And thanks, Omar, for your great points there. I want to turn to some of your questions. There's been quite a few. And Natasha, let me start with you. And Melville made the point on active management in fixed income and its importance. But as with many things in life, I suppose the devil's in the detail. We certainly are strong advocates of not only considering active or only indexation, or only passive, but typically having a blend. I want you to maybe just answer the question. So given the greater market and macro volatility, what are some of the benefits or considerations when following an indexed or an ETF approach to investing in fixed income? If I can ask you guys to maybe just keep your answer brief, but yeah.
Sure, keep this very brief. Just that one point up front is absolutely to agree with what you're saying there. I mean, we also advocate kind of for a blending approach where it makes sense for investors. So absolutely kind of a fan of that. But when it comes to index, obviously that is my bread and butter within the fixed income world. And there's a lot of kind of benefits that we see for sort of the fixed income market and why I'd want to take an index strategy. I think there are a number of myths out there which we like to bust, so to speak, and one of them being that fixed income is an opaque market that is difficult to really kind of to index and to manage effectively from that perspective. But actually, we see it very much as sort of offering a way to slice and dice the market and create more efficiency, to be transparent, not only in terms of kind of the holdings and the indices that you get, but also in the methodologies and sort of the actual exposure and how it behaves. Index has a lot of those transparency benefits. From an ETF perspective, the wrapper itself also offers a number of efficiencies for investors on the cost side, especially when it comes to trading and kind of the liquidity benefits as well. So being able to use them to be flexible in portfolios as well as to allocate more strategically, it really offers kind of a number of different ways to use them within their portfolios.
Amazing. And then quite a few questions. I can summarize them perhaps in a question to you, Melville. Quite a few questions are directed towards, for example, how do central banks balance inflation and economic growth when setting their interest rates? How do you deal with political risk when setting this? I think maybe if we can ask you the question. So, should central banks consider more than just price stability? I mean, should their mandate extend towards economic growth, or is that more the how fiscal policy should be addressing that? I mean, does monetary policy makers have a role to play there? And added to that, how do you deal with political risk when it comes to managing your portfolio?
I mean, that's a fantastic question. I mean, I'll take it as a compliment that you'll ask me, in my opinion, on such global macroeconomic and central bank policy decision-making frameworks. I think, just to simplify it, central banks have had it as their mandate now for, call it 2 or 3 decades, inflation targeting, as their primary objective, which has worked fantastically. So a lot of literature on the topic in terms of how the transmission mechanisms of your central bank policy rate feeds through into the price stability of an economy. But to that point, inflation stability or price stability is a key for macroeconomic stability, more generally speaking. So when it comes to other considerations such as growth outlook and unemployment, of course, central banks globally aren't completely one-dimensional in terms of only focusing on inflation. They take into consideration a number of factors, including growth, unemployment, etc. During the past couple of years, we've even seen central banks, in particular the ECB, commenting on environmental considerations, which of course is also very important. All these issues, social, etc., are very important for any key institution to consider as part of their mandate. But I think when it comes to the key outcome or the primary outcome that I think central banks have and should continue to consider is inflation or price stability. And when, not at all criticism, but I think it's almost factually true is if your eye isn't on the ball or if that isn't your primary objective anymore, then you could see inflation trending higher for longer, or, price stability not being as stable as it has been historically. I'm not saying that's the case at this current juncture. I mean, of course, the more recent inflation trends have been on the back of, factors almost outside of the control of most central banks. But I think, just to get to bring the conversation to a more direct answer, I think that should be the case, more specifically going forward as well, to hold your central bank most notably accountable for price stability, and then factor in other considerations as secondary, tertiary, or derivatives once you've achieved that goal.
Because without price stability, it's going to be very hard to create sustainable growth. I completely agree with you there. Let me turn to Omar for our last question. And Omar, if you can keep it brief, we're fast running out of time. I just want to give you the last say. So we had 1 or 2 questions on, for example, potential challenges to investing in infrastructure projects. What are they? What are some of the risks and some of the benefits that you didn't get time to address that clients might face when they invest in infrastructure companies?
I think possibly one of the biggest risks is on an individual project level is cost overruns. So the fact that you budget X amount, but in fact, because of whatever dynamics, it actually costs much more than that. Now the I don't want to call this a solution, but one of the mitigations of this problem is, of course, diversification. Each company will have multiple projects, and in an index, we will invest in multiple companies, meaning that is that you need a confluence of very specific macro factors for this to be the big risk. What I would say, I think, maybe on the opportunity side is really what you mentioned. We've talked a lot about the directional view and opportunities for infrastructure, but we can't forget the portfolio aspect of it, to balance out an equity portfolio, which today can be very tech heavy, to have something more defensive and uncorrelated.
Amazing. I thank you all, for our panelists, for your wonderful insights. I hope you enjoyed this interaction with us, those of you that dialed in from home or from the office. From our side at Satrix, I'd like to thank you for dialing in, and hopefully you learned quite a bit in terms of the opportunities available in fixed income space, as well as in the real asset space, some of the opportunities. For our expert panelists, Omar, Natasha, Melville, thank you so much for sharing your insights. And from all of us at Satrix, we wish you all the best, and we will catch you again in our next IndexMore event. All the best. Thank you.